the latest NCBA column, we've done a follow-up article to the the June article that we talked about the historical change in market pattern with the impacted by the additional days on feed and the timing of arrival of new crop calves to the market. That article got a lot of attention through multiple avenues. And so for the August article, we did the exact same thing, and we're just taking a look at how does the August contract perform once the June contract expires to expiration. And, historically, those new crop calves first arrived in the market in May. That impact had a negative impact on the June contract and has caused that huge change in pattern. As we roll that out to August, we don't see the same changes at all. And this year has been compoundedly confusing because just the correction in the market and the velocity it's taken is getting a lot of attention. But the point to be made is that we don't expect to see that long-term pattern change with August that we see with the June contract.
Good. So at the end, August may perform like you expect it to, hopefully. Is that...
I think it will. And when I say that with a bit of hesitation, when we have the market lower for 3 consecutive weeks as we've had, it starts to shake one's confidence. But I do think that we get to August. Really, the biggest thing I feel like I've got in my favor on that and seeing a correction is just we've got such abnormally strong basis. And as cattle supply continues to be tight, we're still seeing net gains in retail beef prices and are not seeing any measurable decline in consumer purchasing habits or willingness to pay. So I think as that basis is forced to narrow, we'll see probably both cash some softer and futures higher. But my bias is that August futures will have a stronger tendency to move to cash than cash will have a tendency to move to the discounted futures.
Yeah. And I noticed, Don, in your article, you talked that it's 58% of the time August expires higher.
Yeah.
So it's not a huge advantage, but I thought it was interesting that when it moves up significantly more than when it moves down.
True.
So usually it's on average more positive for August, even though the percentage isn't as high.
The percentages aren't there, and that kind of goes into the explanation that I had just given is what we would expect to see as that contract moves into August and towards expiration. But that historical odds and the rate of improvement, and it states there in that column that particularly with this kind of a sell-off, once we do start to see basing action or see any kind of reversal in the market, I would really encourage the hedgers look at covering those positions before we get late into the contract life.
Do you see some opportunities for those guys that have some hedge positions? Where the market's sitting today, what would you say if you were advising someone or looking at it? What opportunities would you be looking for in the market?
My expectations are that as hard as this correction has been, and where we're down to what should be mathematical retracement support levels, I think the market will find a base and start to recover. As we've talked about, I think that the abnormally wide basis will serve as a driver to push August futures more to cash than cash going to futures. And so for that reason, I think looking to use this break or looking for reversal patterns in the market, I'm trying to stop short of giving an outright recommendation here.
Right.
But I would look for the likelihood that it the producer that looks to use this break to cover the hedges, and what we're saying there, he's going to accept a higher level of risk as that contract goes into expiration. So I don't want to oversell what we're talking about here because it does have inherent risk. But I think I guess my bias is futures will strengthen as it goes towards expiration.
Fully understand, right? Is if you lift those hedges early, you're accepting some risk. But for the guys that are comfortable, and that's part of their program and covering those early, this may be an opportunity when the market has a reversal to pick up some gains, if that's kind of your program. So,
Yes.
Don, I guess kind of a second question on that. Do you see, you have a long run, we have the cost in our risk management, and you start doubting whether that's maybe always worth your dollar.
Yes.
Have you noticed that sentiment as you talk to people in the industry, given the fact that they've written a lot of checks to cover a risk that just hasn't paid back for the last few years?
It's interesting you bring that up. I have had a online chat going on all morning discussing that very thing, and I think there's two. I saw some numbers recently, specifically to LRP coverage, but just what a small percentage of current cattle inventory is under some kind of insurance product. And I think there's two drivers in there. We've talked repeatedly through this short conversation about the abnormally wide basis and that producers simply haven't had the opportunity to lock in a break even or greater. So that's probably the biggest one. The second one you just said is the level of coverage that we saw throughout 2025 with price levels where they was exceptionally high, and virtually all of those policies expired with little if any return, and so that resistance from producers is like I did that last year and I it didn't do me any good at all. So it's always the case. The year they do need it is when they don't, and I think we're seeing some of that right now.
My property insurance provider always reminds me I want to write him a check and never get one in return, right? That's how it's how it's supposed to work. And I think on the commodity side, sometimes that gets a little hard to do. But there is a lot of risk in this market as we've seen these really high prices. There's a lot of downside risk that over time, as they've stayed high, I think we get more acceptable to probably than a few years ago when we first saw these high prices. Don, you mentioned that we just haven't seen the heifer retention numbers. One thing through this process that's been noticeable is the increased carcass weight, which I think you addressed in your last article. Are we kind of reaching the point where we've kind of got those as big as we can? There's not as much. We've been able to increase them over this, but at some point you get to a place where they're about as big as you're going to make them, right?
We are, I hear a lot of conversations that what I'm getting in different meetings that I've been at with representatives from the veterinarian field. They don't think we're absolutely at the maximum yet. The one thing that I would incorporate into that discussion, while we really haven't seen any breakout of consequence yet, and we're still looking at a cost to gain to value gain that is clearly advantageous to put that weight on. But as we get into a more and more probability of corn prices breaking out of the lows we've been at for the last 2 years, as that cost to gain to value of gain ratio starts to narrow, that should at least
economics.
Yes.
The economics will say you can't make them that big. It just doesn't pencil. We may get there before we get to where they just, from a health and soundness standpoint, we can't get them any bigger, which makes sense, but it's a lot of different pieces moving right now, kind of at the same time. Well, Don, I really appreciate your article and you keeping an eye on these changing markets and the trends. We get used to these trends. We start thinking we understand it always does something, but over time we realize that it doesn't. And so I really appreciate you keeping an eye on that for us.
Thanks, Ty. I always enjoy our conversation. See ya.
See you later.